Hello, everyone. Welcome to another episode of In Conversation by Advisor Coach. Today, in conversation, we have once again with us Mr. Pratik Oswal, Chief of Passive Business with Motilal Oswal Mutual Fund. Welcome, Pratik,
Hi. Thanks for having me. Yeah, I look forward to this conversation.
and wish you a very happy new year.
Happy New Year. Happy New Year to you too.
So, by the way, this is the first video podcast I'm doing, at least in the beginning of the year.
Yeah.
And so good that we are catching up on this.
Yeah. No. Same year. I think this is a one of many. So yeah, it should be a good one.
Fantastic. So you launching this new fund offer, Motilal Oswal Diversified Equity Flexi Cap Passive Fund of Funds on 2nd January, closing on the 15th January 2026. So could you just take our viewers as to what drove you to launch a fund with this concept and what's the fundamentals behind this?
Yeah. So essentially, so we have a lot of building blocks that we've launched over the years. So,
Hmm, hmm.
believe it or not, we have about 62 plus funds under the passive umbrella today.
Yeah, yeah.
And all of them get daily flows.
Hmm,
So I think, but we are now in the phase of building solutions
hmm,
because the choice has become quite difficult for a lot of investors. So the idea is that can we build solutions for our investors because we have so many of these building blocks there. So the
hmm,
idea was that can we build the perfect flexi cap portfolio according to us and our expertise
hmm,
for our clients. And
hmm,
that's how we've been doing through this fund. The idea is to keep it very simple. We believe that an average flexi cap fund in India tends to be very large cap oriented,
hmm,
where you have about 60 to 70% investments in large caps and the balance in mid and small. And there's also a 5 to 10% allocation to cash. So
hmm.
essentially, about 70 to 75% of your flexi cap fund today, most
Hmm.
flexi cap funds are very slow moving. So
Hmm.
what I
Hmm.
mean is that if you look at the earnings profile of large cap companies are very low compared to mid and small.
Hmm.
So we wanted to build a flexi cap portfolio that's very low cost, transparent, and also systematic, and which is more targeted towards growth. So we
Hmm.
built a flexi cap fund where we have a combination of, so the allocation is very simple: one third large caps, one third mid caps, and one third small caps. We
Sure.
believe that
Sure.
this allocation is actually, even though it's very simple, we've tried a lot of permutations and combinations over the last 4 to 5 years time, and we believe that the equal weight as a combination actually works out pretty well for investors, and that's how we managed to grow this fund. So this fund is essentially an FOF,
Hmm.
where you'll be buying, one third of your money in a Nifty 100, one third is the mid cap index, and one third split between small cap 250 and micro cap 250. So you're
Hmm.
essentially covering the entire universe of stocks in India in a single fund, where you're actually getting a slightly higher tilt towards the mid and small caps, which means that the growth and the wealth creation that you can expect in this fund will be
Hmm.
higher than what you can expect in traditional flexi cap fund. So that was the idea.
Sure. So tell me something. So it's essentially a feeder master, but in
Yeah.
a format, of course. And so will it cover all the stocks in that indices, which means I will be sitting at almost about what 250 and 500,
750.
750 stocks?
Yes, yeah. So you will be investing in 750 stocks, will be
Hmm.
essentially investing in all of India's market cap.
Yes.
So
Yes.
about 90 to 93% of India's market cap in a single fund.
Hmm.
But it will be structured in such a way where you will have equal amounts of your investments in large, mid, small.
Yeah. Yeah.
So essentially, if you buy a Nifty 500 fund,
Hmm.
which I think is also one of the best funds out there.
Hmm.
Even that fund is approximately 65% large caps,
Hmm.
followed by 20% mid caps and 15% small
True.
caps.
True. True.
So this fund we believe has the ability to outperform even the Nifty 500 by
Right.
about 2.5%, which is what we've seen in our sort of back test and our sort of return stream. So
Hmm.
essentially, you're literally getting a product which is a flexi cap product, which has a passive cost attached to it, but
Hmm.
has a performance of more actively managed funds.
Hmm.
You
Hmm.
should essentially, expect 2 to 3% outperformance over
Sure.
traditional, multi-cap or flexi-cap schemes.
Sure, sure, sure. And I'm sure you did some back testing in terms of how the results have been. How
Yes.
were they?
Yeah, so essentially, if you look at this fund over a 15-year period,
Huh.
this fund has essentially delivered about, or at least the index is not the fund. This is more of a back test, so just keep that in caveat.
Yeah.
So the back test is done about 15.5% over the last 15 years,
Right.
which is close to compared to the Nifty, that's uh, about a 2.5% outperformance. Actually, almost 3.5% outperformance over the Nifty
Sure.
15-year period, and it's approximately the same over the even the last 5 years. For example, Nifty 50 is done about 16.5%. This is done about 25%. So essentially, what we're seeing is that mid and small cap is where the growth is. I think more than looking at backtesting, I think what investors are getting in the future,
Right.
what we've seen is that stock markets tend to over the long term converge with earnings. So if the earnings of something is strong, the stock will go up. If the earnings is poor, the stock will go down in
Absolutely.
the long run.
Absolutely. Yes.
And we
Yes.
believe that the earnings profile of large cap companies is in the single digit, maybe 5 to 10%,
Hmm.
whereas the earnings profile of a mid and small cap is in the double digits, say 15%
Absolutely.
plus.
Yes.
So I think because you're tilting your portfolio towards high earning or high growing, fast growing companies, you essentially can expect that higher alpha coming into this sort of a front. So that's the idea behind this. But historically, as I said, we've seen about say over the long term, 10 to 15 years time, about 2 to 4% outperformance over say a Nifty or something. So it's a good low cost way of I think beating the
Yeah.
benchmark while having the transparency cost and the structure of a passive fund. And even though this is an actively managed fund by the definition of the regulator, we believe that we are not going to manage it actively. We're just going to inherently just invest one third, one third, one third in each market cap. And what we're also going to do is to rebalance the portfolio every quarter.
Every quarter. Okay.
So
Sure.
yeah, so
Sure.
every quarter, essentially, if we see that the weights go up and down by 5%, say you have a 33%
Hmm.
allocation to
Hmm.
large caps, and that goes below, say, 28%, then we would rebalance. Or if the 33 goes more than, say, 37, 38%, then we would rebalance.
Sure. Sure.
So,
Sure.
so what
Sure.
this does is that it also limits amount of churn in your portfolio, amount of unnecessary churn in your portfolio, and I think that's the beauty. So in the last 15 years, we've only had to rebalance this portfolio about 7 to 8 times. So it's fairly low churn, and also I think very stable portfolio that we've seen.
Sure. So essentially, 750 stocks covering the entire market cap, almost about covering all the sectors, 70 to 73 sectors which we have here. And you mentioned about the quarterly rebalancing. Now, one question which comes to my mind is that this one third, one third, one third. Now, markets being very dynamic. Obviously, there could be points in time where there are dynamic shifts in the market caps, and clearly a market cap really underperforming, and we have seen that at least in the past recent 2 years. So what do you do then? What? So is there a leeway that you can intervene? You can make some surgical, inputs into it, or you just let it be the way it is?
Yeah, so these are very diversified indexes. You're investing in 750 stocks.
Mm, mm,
So essentially you are not taking any stock specific risk in your
mm,
portfolio,
mm, mm,
which I think one thing. So even if there's stocks that fail or
mm,
stocks that go bust, it's not
mm,
going to have any meaningful impact in your portfolio. So that's one. So you're very diversified. The second is that yes, there will be times when there's a mid cap crash or a small cap
mm,
crash or a large cap crash.
mm,
Honestly, those are good things. I would
mm,
want that to happen.
mm,
Why would I
mm,
want that to happen?
mm.
Because what happens is when you're rebalancing the portfolio and if there's a crash in mid and small cap, you would
You get
actually
more
buy
stock.
more mid and small
You get
cap
to buy
and
more,
you could sell
absolutely.
large caps and
Mm,
vice versa. If mid and small caps are growing in size and mid caps have become very expensive now,
mm,
you would
mm,
automatically sell mid and small cap and buy large caps.
mm,
So
mm,
essentially, I think the whole idea behind this fund, because it's equal weighted, is to
mm.
actually hope for these things to happen, because then you can take advantage by rebalancing the portfolio and by making sure that you are actually making your returns. So essentially, you are
Sure.
actually buying low and selling high. If large caps run up,
Yeah.
you're selling them. If small caps run up, you're selling
Mm,
them, and you're buying the other asset classes. So I think it's a great way of keeping the both large, mid, small under check. You're actually doing the opposite of what most investors do. So we've done this study, very good study, with that talks about what happens when you chase winners. Unfortunately, if you look at the
mm,
Indian equity markets, especially mutual fund industry, there's a lot of herd mentality. there is, and this is not regarding
Of course.
funds, but this is actually funds is fine. This is actually to do with market caps. When small caps are doing
Mm,
well, that's when people pour into small caps. When large caps do
mm,
well, people pour into large caps. When
mm,
equity does not do well, people pour into balance advantage, gold, silver, all of that. So the problem we've studied that we've seen that when investors buy last year's best performing market cap, they're actually making about say 12.5% returns, which is under the benchmark.
mm,
Now we did the opposite. Now what if you buy yesterday's losers?
mm,
So
mm,
what if you buy the asset class that did badly last year, and we do it
mm,
systematically over 15 years?
mm,
We
mm,
see
mm,
that that has an outperformance of 1.5%, 2%.
mm,
So actually buying what's not working works better. But
mm,
then we did a third iteration where you're not buying the winner or the loser. You are just managing a systematic portfolio of one third,
mm.
one third, one third.
Sure,
And
sure.
that actually ends up doing the best. So actually what we're seeing is that, timing the markets is very difficult.
Oh,
Choosing
yes.
winners and losers is very difficult.
Yeah, absolutely.
So the best actually strategy is to have a fixed asset allocation and you're continuously just, rebalancing your portfolio and keeping it fixed. So this is the power of asset allocation that we're
Mm.
trying to mention in this portfolio by having a fixed thing in a portfolio.
So essentially, of course, you're so right because market cap leaders rotate and the winners rotate year on year. So even if there is a view, for example, that Nifty 50 essentially covering about 12 to 13 sectors, that there is going to be a considerable long-term underperformance, correct? You will continue to stick to the strategy because that will give you essentially an opportunity to keep rebalancing your portfolio and moving more towards a large cap because that's what essentially this fund will behave as.
Yes, exactly. So what we've seen is that this because about 65% of your allocation in small and mid cap, there will be underperformance when there's a drawdown in the market
Mm, mm,
because large
mm,
caps tend to fall less. So
mm,
yes, we expect that during periods of bear market. So there's bull, bear, and recovery. These are three
mm,
market conditions that we've studied. Bull markets is doing extremely well. Recovery
mm,
market is
mm,
doing extremely well. Bear
mm,
markets is will slightly underperform because
mm,
obviously the higher allocation of mid and small cap. So I think investors who are wary of bear markets, should ideally maybe focus on a more large capish portfolio. But we believe that markets going forward are mid and small cap is where the action is going to be. So I
mm,
think if you're able to take a little bit more risk, you're able to structure your portfolio
mm.
in a more growth effective way, then this strategy makes a lot more sense. The
Sure.
third thing is very important and it's people fail to realize. But if you look at the back test, I would not take the back test very seriously. In fact,
Mm,
I would almost think that the back test is not the nowhere close to what things will pan out in the future. Why would I say
mm,
that? Is because if you look at the average small cap company in India,
mm, mm,
even 7 years back, 7, 8 years back, an average small cap company in India was 4 to 5 thousand crore market cap.
mm, mm,
Today, an average small cap company is 25, 30,000 crore.
mm,
So the size of these small cap companies have grown. They are trading like mid caps.
mm.
So when you're buying small caps today, you're buying mid caps of
Right.
yesterday. When you're
Yes.
buying mid caps today, you're buying large caps of yesterday.
Correct.
When you're buying large caps today, you're essentially buying slow moving stocks,
Yeah. Yeah.
which
Yeah.
are more stable, will not give you much
Yeah.
value accretion.
Correct.
So
Correct.
I believe that the drawdowns that people have seen in the past, I
Mm,
don't think they should expect the same level of drawdowns in the future. So for example, 2018, if you remember, small caps fell by about 60, 70%.
yes.
I don't think that situation will come. I mean, obviously, I mean anything can happen,
Yeah.
but all I'm saying is that the probability of the same thing happening again is very low.
No, for that to happen, I think essentially something really unsystematic uh,
Exactly,
risk has to
exactly,
happen, which is completely beyond everybody's control. But I think as long as what we can assess and what we can, as far as visibility can understand, such a risk is quite not there.
exactly.
Not there. Tell me something, Pratik. One more question which comes to our mind is that, while you were talking about this fund, that essentially when an investor comes here and invests the money, he definitely learns a lot of discipline through investing in this fund. So could you highlight some of the disciplines which this investor automatically gets guided towards?
Yeah, yeah, it's a good question. So the biggest discipline I would say that investor gets through this fund is that there is no fund manager risk. So
Hmm.
investors don't have to worry about performance. That's
Hmm.
number one. The second is that there's a low cost product. So investors can invest and forget for life and they'll be sorted. The third discipline is the fact that you are essentially, you know what you're getting. You know that not now, but even in 10 years now, 15 years from now, you are essentially getting a fund that invest one third into large caps, one third into mid caps, one third into small caps. So you are essentially know exactly what it. So for example, like a Nifty 500 product.
Hmm. Hmm.
So Nifty 500 product actually is very interesting. Where when we launched it 5 years back, it was 75-80% large caps. Today it's gone down to 65% large caps.
Hmm.
Maybe in 10 years time it'll go down to say 50-55% large.
Yes, absolutely.
So it becomes more of an maybe in 20 years it becomes a mid and small cap strategy. So I
Yeah,
think whereas in this fund you're getting something very systematic.
yeah, yeah.
So one is obviously the passive nature, transparency. There is no, and the second is you're getting the same risk. The
Hmm.
only and also investors don't have to worry about rebalancing the portfolio. Today, what happens is that if an investor today wants to buy the caps separately, say I want to buy a large cap fund, a mid cap fund, and a small cap fund. Now,
Hmm.
what happens is that they will rebalance it at some point, right? That will enable tax.
Hmm.
In this fund, because you're part of a mutual fund structure, there is no taxation.
Absolutely. Very
So
true.
you're getting something which is rebalancing systematically every quarter,
Very true.
which also is a huge benefit. So
Yeah.
literally, you can allocate this as 25% of a portfolio.
Yeah.
And actually, the way I see it, this is like all the this is the portfolio that you need.
Actually, yeah, this
The core allocation.
absolutely. Yeah, this can be the only portfolio you need, technically speaking.
Yeah, yeah.
Very
Your
true.
entire equity allocation can be in this one fund.
Yeah.
So I think that's why we think it's a very interesting fund to.
Yeah, absolutely. I completely agree with you. Yeah. So essentially, this opens on the second January, which is today. It
Yes.
closes on the 15th of January, right?
Yeah.
So, what message would you like to give, to all the viewers listening, to our video conversation about why this fund, how well it fits into, you know, the portfolios, etc.
Yeah, so I would like to say that we've launched a lot of funds in the last 5 years, and I would say the fund which I would recommend the highest would be this fund.
Hmm.
If you ask me this question 5 years from now, I'll say the same answer. So I think in terms of your equity allocation, I think this is a very good fund. It's more
Yeah.
growth oriented. I think unlike the US, where a lot of the innovation is happening in large caps, like the top 10 stocks in India, unfortunately, there's not a lot of happening in top 10 stocks. So ideally, I would ask investors to, put more of their money into mid and small caps, which is where this fund does very well. And also you're looking at, the upcoming companies which are growing at a much faster rate. So I would say that this is a very good fund where you can expect some alpha over broad-based benchmarks. You're getting a rebalancing structure for free. So there's no cost tax involved. It's a low cost passive fund. It's something which has not much fund manager risk. So you don't have to worry about underperformance. Only thing you have to worry about is that in bear markets, they may underperform because it's slightly tuned towards mid and small cap. But we believe that this is a very good, simple fund that investors can invest in. Because it's so simple, there's not much to talk about. Uh, and I think that's why it's a fund that is, super easy to
In
hold
fact,
on for a long
in
time.
fact, I will just add to your point that when there are bear markets, and this fund will tend to underperform naturally. So, well, your SIPs are working at the best. At
And in a bear market, what's going to happen is that you will rebalance your portfolio in such a way
yes,
where you
absolutely.
will actually sell large caps and buy more mid and small.
Yeah.
So in fact, the volatility actually works well for this fund
Mm,
because of the
mm,
rebalancing structure.
absolutely. And essentially, if you look at the markets, how they have been last 5 years, last 10 years, the definition and the constituents list of a BFSI or a services sector has completely changed. The companies which we are seeing, which are doing very well in the service sector, such kind of business was not even thought about that it could even exist a decade ago. Correct.
Yeah.
And this fund automatically, will keep including and excluding and rediversifying while the indices keep shaping up.
Hmm.
So you know what I mean from that aspect. Like, who would expected that I would get my stuff sitting at home in 10 minutes?
Yeah.
You know,
Yeah.
so automatically such companies will come in, and I'm sure in the next 5 years there'll be further more companies, which will be coming. So this kind of gives you a flavor as you just sit in it.
Absolutely. Absolutely. So I think the beauty about an index fund is the fact that you will be relevant for life.
Hmm.
So if you invested in a Nifty 50 index fund 20 years back, you would invest in oil and gas,
Yeah,
infrastructure.
that's
Today,
right.
you're investing in financial services, IT. Tomorrow, it might be something else. But
Absolutely.
guess what? You'll always be invested in the top stocks because it'll
Mm,
always evolve.
correct.
I think, and also, so it's a very Darwinian way of investing.
Mm,
It's low cost, so most of your money is invested. So
mm.
we believe that any strategy that you create from, and also it's true to label.
Yes.
So a small cap index is 100% small caps.
Mm,
If you look at most other funds, say actively, I mean, I have nothing against actively managed funds, but the comparison is, I keep telling is that a small cap, say active fund would be 35% mid in large caps,
mm.
whereas yours 100% small caps, 100%
Yeah,
mid caps,
yeah,
100% large caps,
right.
with no cash allocation. So there is no
Correct.
cash. So it's 100% invested. So all of your money is invested in the underlying stocks, and obviously there's not much cost involved. So overall, what we're seeing is that this is a very good way of investing in the equity markets. I keep
Mm.
telling investors is that the asset class that gives you the most amount of money is equities. And mutual funds simplify equity investing. Index investing simplifies mutual fund investing. So it's the simplest way of owning the best
Yeah,
asset class,
absolutely.
and there's a good structure.
And there is no intervention here as to what part of 33% should I buy in large cap or mid. Essentially, the investor is getting into all 750 stocks throughout this indices.
Exactly. Yeah,
So
yeah.
so
You're also getting a very good. So the way also I see it, there's a lot of demand for equal weight indexes.
mhm.
I feel like this is the probably the best equal weight index in India today, where you're there. It outperforms all others. But forget that. That's not important. What idea is that this is also the simplest, where you're doing equal weight caps, mid, large, mid, small.
Absolutely. Fantastic. Fantastic. While I was going through the presentation, I was getting very excited because I found this fund to be very different and very unique in its own way. Fantastic. So, well, for our viewers, this is Mr. Pratik Oswal, Chief of Passive Business with Motilal Oswal Mutual Fund, as they launched their new fund offer. A very, very interesting proposition, as you heard Pratik talking about it. The Motilal Oswal diversified equity flexi cap fund of funds, passive fund of funds, being launched today on 2nd January and closing on the 15th of January 2026. Thank you, Pratik, for taking out time for this conversation today.
Thank you so much. Thank you for having me.
And for our viewers, let me remind you that please press that subscribe button and subscribe to the Advisor Coach YouTube channel if you haven't done yet for multiple such interesting and very intellectual videos. Thank you, Pratik. Thank you very much for your time.
Thank you.
All the best. Thank you.